Hello and welcome everyone. We have been always doing, webinars from a closed room where I could never see who all are joining. But this is first time I'm doing like a Zoom meeting. This is like I think a very different experience. But all the more I think lively experience. I can see many of our clients who have logged in, and we can kind of keep this as a interactive forum. And Rajesh, who's our speaker today, needs no introduction. He is the founder and owner of Alpha Accurates, only PMS amongst many which has completed 15 years. Otherwise, we know many mutual funds which have track record of more than 10 years, but there's hardly a PMS which has a track record of more than 10 years. And Rajesh Kothari's firm, which is Alpha Accurate, has completed 15 years and has been consistently building wealth. If anybody would have invested in Rajesh strategy 15 years ago because of its very long tenure and consistent return, one would have made massive returns, massive wealth. And that obviously, talks a lot. And that is where we thought of doing this webinar with you, Rajesh, because the present times as it is going on, we know we are kind of seeing global headwinds while the domestic resilience is firm. But because of global headwinds, markets are range bound. And you have always talked about a term VUCA. You have always mentioned about volatility, complexity, uncertainty. And this is the time which is actually around all those I would say attributes. And you have always talked about preserving wealth first, and then kind of making returns. And you've always maintained relatively a low churn approach and diversified approach, which obviously all these things come at a cost of maybe not giving very high return but a very consistent return. So in that, from that point of view, we thought of doing this webinar with you, and welcome to this entire forum of our clients and investors at large. Before I kind of start discussing with you all the questions which I have in my mind, I just want to open it up for you to kind of give your opening remarks on what are your present thoughts on the current markets.
Great. Namaskar. Thank you, Kamal, for giving this wonderful opportunity. PMS AI World is, I think, pioneer in showcasing the different PMS products from last, I would say, almost now 5+ years. And I think is one of its kind platform, because PMS industry was not so known, but thanks to efforts by Kamal and your entire team, today probably PMS industry is well known for the investors. So thank you very much, Kamal. Thank you very much, PMS AI World, and thank you very much to all the participants for joining this webinar. And I was just talking with a few friends that if you look at last 12 months, market is up 0%. Now, whether this zero number is good or zero number is bad, it depends how you look at it. If I had told you 3 years back that on 6th April 2025, on front page of Economic Times, you will have 4 wars ongoing. Russia-Ukraine war, Israel-Gaza war, Israel-Iran war, and then US entered in that war, and US-Iran war. Not to mention the small India-Pakistan related geopolitical uncertainty. I would have told you this exactly 3, 4, 5 years back. You would have said, let's get out not only from equity market, let's also get out from the debt market. सब पैसा लेके घर पे बैठते हैं. But think of it. We had 4 wars, geopolitical situations, and on top of it, we had an economic war which is called tariff war. And despite these 5 wars, on 7th, 8th April, when that was happening on the front page of Economic Times, Dow Jones was positive and Nifty was positive. So I was just thinking internally, I was speaking to my mind that normally when people ask us, in a closed door meetings, Rajesh bhai, what do you think? What if scenarios? And we used to say, and we used to write, even today we write that what if scenario, the biggest risk is geopolitical situation. But now we have seen even the geopolitical situation, the 4 wars happening, and the crude oil still was $69. And Nifty was 0. It was not down 20%. It was not down 30%. It could have been down 30%, and we all would have agreed that why it is down 30%, bound to be, because चार वॉर अगर बाहर चल रहे हैं जहां पे यूएस, रशिया, यूक्रेन, नाटो सब लोग कहीं ना कहीं तरह से जुड़े हुए हैं, और उसके ऊपर से एक बहुत बड़ा सा टैरिफ वॉर चल रहा है, तो मार्केट 20-25-30% नीचे ग्लोबल इक्विटी मार्केट हो सकता है. बट द फैक्ट रिमेन्स दैट इट हैज नॉट हैपेंड, एंड दिस वी वुड नॉट हैव इमेजिन्ड 4 years back. And we would have said that if you think there is going to be war, keep money in cash. Don't put in even FD. Don't put in debt market, because if there is a war, nothing remains. Only cash is king. So that proves about how the geopolitical situations have changed. And that also proves a very, very, very important message which I want to convey through this forum, that the global political leadership, global economic leadership, the bureaucrats, the Fed, the RBI, the government agencies, they all know one important thing, and I think they have learned lesson from Lehman collapse, that come what may, the economy should not collapse. Very important. The war can continue. It can be targeted war specific to a particular person or particular region or particular territory or particular objective, but it cannot be a full-fledged world wars resulting into loss of economy. Now, this is very, very important message which I am trying to convey, because at the back of the mind of investors, whenever you invest in equity, we always say that be ready for what if scenarios. But today, after looking at this war and the tariff war, probably we all can say that हमने तो ये भी देख लिया है, फिर भी बाजार में कोई ज्यादा प्रॉब्लम हुआ नहीं. प्रॉब्लम है, लेकिन मार्केट जीरो है. It is not down 30, 40, 50%. And that is the resilience of the market, and that is the wisdom of this political global leadership, that they will not allow economy to fail. They will not allow world GDP to fail, and therefore they will not allow corporate earnings growth to fail, and therefore they will not allow market to go down. So that is a one important point which I wanted to start this with, this conference, that the resilience is going up. The economic resilience is going up. Char war and crude oil is 69. Nobody would have thought, correct? So that's first important thing which I wanted to convey. The second important thing which I wanted to convey is that, think of it. In last 10 years, 12 years, or probably last 18, 20 years, except that limited COVID ka jo window tha 3 mahine ka, if you take out that period, tell me one incident where you would have seen 4 government agencies working together. And they are not just working together, but they are front loading their action. This has never happened. RBI injected 11 lakh crores in the system. RBI announced 100 bips rate cut. Finance Minister in the budget announced income tax cut. Central government has done 35% growth in capital expenditure for the month of April, May and June. And now the GST 2.0 reforms. It's just not an action, but it's a front loading of the entire action. I mean, they could have done 25 bips rate cut and after 9 months announced another 25 bips. But no, this time they announced their intent very clear, that we are going to do overall 100 bips rate cut, of course, in the 3 phases. So lower inflation, lower interest rates, the coordinated action by all agencies by front loading their action plan to revive the growth. This all things means the macroeconomic environment was not so good at any point of time in last 12 years. And all this macroeconomic environment is going to have a positive effect on the economy with maybe 2, 3, 4 months lag, depending upon when it comes. Not after 3 years, it is after 1 quarter or so. So the macroeconomic environment is going to improve. The worst is over. The biggest villain, Kamal, if you ask me, that who was the biggest villain in last 1 year? The biggest villain ultimately is the earnings growth. And the Nifty reported only 5% earnings growth. With 5% earnings growth, market can give you only zero returns. Because for growth to be double digit, then only returns can be double digit. But thankfully, because of this coordinated efforts and action plan, growth is now going to revive. And it is not going to revive after 3 years. From second quarter itself, 1Q is already over. From second quarter itself, you will see Nifty to come back to double digit. And by third quarter, fourth quarter, and for full year FY27, it is going to be 12, 13, 14, 15% earnings growth. So growth is going to come back. One, macroeconomic environment is going to improve. Number two, the earnings growth from low single digit will move to double digit. And number three, the most debatable question, are we overvalued? And we are not. Our 10 years average price to earning multiple of Nifty is roughly 22 times. And currently we are trading around 22 times. We are not cheap, but we are not expensive either. And with the improving earnings growth prospects, and with the reducing interest rates, and with the improving quality of balance sheet, we deserve 10 years average price to earning multiple of 22 times. So even on valuation, we are reasonable. With growth is, as I said, is going to improve. Probably we are now attractive. We are already in month of September 2025. If you take March 2027, then we are trading at very attractive valuation of around 19.1 times. And therefore, this is a good time to be into the equity as an asset class. With that, I would like to open up Kamal to you, and feel free. I think it's always better to be more interactive. Thank you for hearing us very patiently, and looking for more interactive session.
Sure, Rajesh. So I think, whatever you have mentioned is something which is kind of a conclusion ultimately we want to reach to, because by nature, we are optimistic. And whatever you have mentioned, obviously, fundamentally is all correct. And we know that, yes, that pain is behind us. But at the same time, the global headwinds, the way kind of geopolitical environment it is shaping up. And another risk is that from the point of view of the new money, which is new young money, which has come from many new young investors over last 5 years after COVID, is yet to see any deep correction. And correction, unless it is the kind of correction that actually equity market has been seeing in last 40 years of my experience, is something that doesn't give learning to some of these new investors. And that is where some of these, I would say, large mutual fund houses, they are also sitting on cash, and many PMSs are also maintaining 30, 35, 40% cash. And many fund managers I interview, they tell me that if more money keeps coming in the way it is coming, we do not have many ideas. In fact, we do not have any ideas to deploy more money. We are just kind of adding money to existing ideas, and that is where we want to sit on cash. All that reality also is there in this environment, which is the state of flux, when more and more liquidity is coming from domestic investors. And kind of that is where maybe the corrections have not happened, which obviously is another reality. How should investors kind of react? Investors are fully invested in equity, but at the same time, you as a fund manager, you also face this problem when you get more and more money. And investors definitely have a long term horizon, but at the same time, there's an opportunity cost to everything. Like, not putting money in equity means losing returns of gold, or maybe losing returns of fixed income as well. So how would you address this particular time at present? Because there are fund managers who believe that even if we see some comeback of earnings, till the time we do not see a major comeback of earnings, markets are not going to kind of see a kind of massive rise, or we see a fall, which kind of make valuations attractive. Because unless either price falls or earnings rise significantly, we are in somewhere instead of I would say continuing this pain because of liquidity, and liquidity coming from obviously majorly retail investors who are like obviously now investing more and more in Indian equities.
So, Kamal, see, till March even we were cautious. We have been telling all our investors to go for STP, systematic transfer plan, do a staggered approach. But from the July, August, and now September, we are telling investors do not wait. Please understand, equity markets are always a little bit forward looking. And when I say forward looking, I'm not giving you 2030. I'm telling you March 2027. And you and I, we both are aware that if the macroeconomic environment turns better, आपको क्या चाहिए? Finally, growth चाहिए. For growth, what do you require? If interest rate goes up, does it improve demand? Answer is yes. If the inflation goes down, does it improve demand? Answer is yes. If the income tax reduces, does it improve demand? Answer is yes. If cost of goods comes down because of the GST rate cut, whether it lead to improvement in demand? Answer is yes. But if you say, no, let all these things get visible and then I will invest, then you have to pay price for it. Correct? So, macroeconomic growth indicators, as you look forward over next 3, 4, 5 months, and I'm not saying all this will happen. It is already announced. I'm not predicting this will happen. This has been already announced by the government. And therefore, the inflation number print is available for both of us. Interest rates are available on daily basis to everyone. Home loan rates are reducing starting from 1st September already. And therefore, all this will lead to improvement in demand. Correct? Now, question of how much cash one should hold, whether you are seeing opportunity, that varies. Every manager might have different universe and different set of basket. But let me tell you one thing, Kamal, that at times, we should avoid the noise. There is too much of noise. One noise is there is no growth. In India, mein growth nahi. I often get this comment, bada growth kuch hai nahi. Completely wrong statement. The first quarter earnings results are already out. Correct? And if you look at the 500 companies, BSE 500 companies, there are 222 companies to be precise, which has announced 15% plus EBITDA growth despite challenging macroeconomic environment. 222 companies, almost 48%. You need to invest into where you think there is going to be growth. Correct? If you think there is no growth, it is a wrong statement. If you think it is a hyper growth, again, it is a wrong statement. There are winners and there are losers. As an active investment manager, our job is to identify the companies and be on the right side of the curve and the monitor business cycles and invest a little bit ahead of time. And you get growth and valuation both upside if you are lucky. If not, at least you get the growth upside. And there are enough number of companies, if you look at in last 1 year, which have done decently well. For example, if I look at my own portfolio, so we run 2 primary portfolio, multi-cap and budding beast, as you are aware. My IOP portfolio has 20% profit growth for the first quarter. My budding beast portfolio has 25% profit growth for the first quarter. And this is supported by 20% revenue growth. So there are enough growth opportunities. One should not worry too much about what will happen on day-to-day basis. Yes, volatility will be there, macro uncertainty will be there, and that's where the opportunities. Volatility nahi rahegi, the opportunity kaise milegi? When everything is green, it will be 1 lakh Sensex, and then if you invest that time, then you will get zero returns. You have to invest when there is some confusion. Some skepticism is always good. It's a healthy debate. If everybody says, we like equity market, that's the time actually as a manager, I get worried. Because that's the wrong thing. It's a euphoria market. This is a good time. 1 year of time correction has happened. You just run one filter. How much percent of stocks are down 35% from their 52-week high? Almost 60% of BSE 500 is down more than 35% from its 52-week high. So correction has been decent, time correction has happened, price correction has happened, and maybe another 3 months, market may not do plus minus, who knows? But take at least 3 years view. I'm not saying taking 10 years view. Great if you can take 10 years view. But take at least 3 years view. Do you think Nifty will deliver 11% growth? GDP will do 11%, 6% real growth, 5% inflation, 11% nominal GDP growth. Can you Nifty deliver 11% earnings growth? Very high probability. Am I right? And if Nifty delivers earnings growth of 11%, market will give you 11% returns. And good managers, if you do the right stock picking, and if you identify companies which has a potential to grow 15, 18, 20, 25, and that's where the alpha managers delivers his job, and probably they will do a little bit better than the benchmark. Now, on this, one should not have any confusion. One should be crystal clear what one should do and why one should do. But of course, can market go down by 5%? It can go down 10%. So what? But if you are sitting in September 2025, and if you have a view of September 2028, will you make decent money compared to any other asset class? 100%. So avoid the noise, stick to fundamentals, stick to basics, and keep creating wealth.
Right, Rajesh, absolutely bang on. So obviously, I am 90% invested in equity, and I understand whatever you are saying. And this is the real way of asking questions from the point of view of clients, so that all aspects are addressed, and
Sure.
reinforcement of optimism. And obviously, these are those times which kind of demand investors to kind of show their conviction. And when they invest, they obviously say that we want to invest with the horizon of 5 years and 10 years. But obviously, when patience is tested, they need to be reminded that you are here for long term. And obviously, I am with you on whatever you have mentioned. But now the subsequent aspect is that where does opportunity lie? We want to also understand, because we are educated investors, though we have given funds in the hands of fund managers like you, but we want to be informed that now when GST cuts have happened, where does it really impact, which sectors it really impacts positively, or if any sector which gets impact negatively, or if it is just a political sham, if it is not really going to have, like we have been saying, tariffs are going to have maybe 30 basis points of negative impact on GDP. Similarly, what is the impact of tariffs? A positive impact on GDP. If you have any such fundamentals, that'll be very interesting to understand.
Basically, the cut in GST, coming to your first thing, the cut in GST and its impact. The cut in GST, definitely, I would say it is a required. If you would have not done it, situation would have been the worse. It is a very, very important step, because if you look at the consumption basket from last 18 months, it was weakening every day. And if it would have not done, then it would have been collapse. So it was required, because on one hand, particularly at the lower strata of demographic, the income growth is constrained, but the cost keeps going up. And because of this gap, post-COVID particularly, the gap between the cost and income, particularly at the lower end of demographic, has impacted massively. The good thing, what this government has done in this GST reform, is that they have not made a major difference between the lower strata and the middle strata. Forget that luxury 40%, but 95% of households which gets covered in this thing, they have not kept it too complicated and creating multiple slabs. And therefore, on net basis, it will have a multiplier effect on Indian economy. Consumption will improve, primarily wherever there are beneficiaries. But even if there are no direct beneficiaries, there is an indirect impact. And that indirect impact can lead to the better consumption across the various segments. That doesn't mean tomorrow you should buy FMCG stocks. It may not necessarily mean that, because roti, kapda, makan, hamari basic requirement, everybody's by and large is catered to. So it doesn't mean people will take, instead of taking bath one time, you will take bath 2 times. Definitely not. But it leads to some savings, and that savings gets spent, maybe apparel, maybe auto, maybe discretionary items, maybe some education, maybe some better hospitals, and so on and so forth. The behavior and the consumption patterns have changed in last 5 years. And the requirements and the aspirations of Indian consumers are going to other levels. And therefore, it will help customer and the consumer to meet their growing aspiration. That is one part of it. Second part of question, you asked that which are the sectors, generally speaking, what we like. And I think that while there are 2-3 sectors, which of course is going to be overall high growth over the next 3, 4, 5 years. But there are across sectors, we believe there are winners and also we believe there are losers. Now, this is something very, very important because 3 years back or 4 years back, somebody took sector A and entire sector did well. Like somebody talked defense and entire defense went well. But now it is not going to be that easy. It is not going to be sector approach. It is going to be winner versus loser approach. Let me give one example. Like if you talk about two-wheeler automobile industry, and since we are giving few names, I would like to give a disclaimer that company which we may talk as an example are not recommendations and we might be holding in our PMS or in other offerings or in our personal capacity. So these are just illustration. These are just example and we might have investment. So please note this disclaimer. So for example, automobile industry, if you look at the two-wheeler, you have one company, the Hero Motor Company, which is reported almost zero growth. And if you have another company called TVS, which has delivered 20% growth. So if somebody says two-wheeler sector looks very good, he's wrong. If somebody says two-wheeler sector is very bad, he's equally wrong. You need to be on the right side of coin. If you talk about the largest Indian consumer company, Hindustan Unilever's, Nestle's, their growth has been 5%. But if you look at the India's largest retail company, again in consumption, the trend, it's growing at 25%. If you look at the India's largest capital goods company, it's growing at 12, 13, 14%. But if you look at the India's largest HVDC capital goods company, it is growing at 65%. If you talk about the mega company in IT sector, which is growing at 6%. But if you talk about the mid-cap company in IT, which is consistently growing at 25%. Every sectors, there are winners and losers. And therefore, the selection of the stocks and the monitoring of the business cycle, that is critical. Of course, there are few sectors which are emerging sectors. They are high growth sectors. For example, data centers. For example, electronics manufacturing, EMS players. For example, hospitals. For example, housing finance. For example, auto ancillaries. These are little bit higher growth compared to the average growth of the sectors. But that doesn't mean that the opportunities are limited only to 3, 4, 5 sectors. Like in banking and finance, if you look at the housing finance companies, they are growing at 22%. But if you look at the large banks of this country, probably is growing at only 7%. Every sector, you need to select the right companies. Selection is the master key for next 18 to 24 months. We must have sector agnostic approach in my view. The top-down approach will not work too much for next 18, 24 months. Stock selection, the bottom-up and the discipline will be the key to generate better alpha to investors.
Right, Rajesh. There's another aspect which is, being marketed or being seen fundamentally, which is investing globally, especially China, because Chinese equity markets in last, I would say, 8 months in this year have really recovered almost 35 to 40%, but in last 3 years had not done anything. And as an economy, obviously China is far bigger in size, and there are companies which deserve investors' attention, and there are fund managers which have been kind of creating funds which are claiming to invest in Eastern Asia and China. So what are your views? When you invest your own money, it's like again trying to understand it from realistic perspective. Would you allocate your money outside of India, and if yes, in China, or if no, then what are the reasons?
See, I think again there is a myth that India is expensive compared to many Chinese companies. Ultimately, every country has opportunities. Like I said, in India also in same sector, There are companies which are zero growth. There are companies which are 20% growth. So there are similar companies across the world. And there is nothing wrong to invest in any such companies if it is available at reasonable valuation and with good growth and good discipline and good governance and good transparency. But tell me one thing. You are sitting in India, and as an investor, your ability to predict the Indian companies versus your ability to predict the Chinese companies. Mind you, even FIs invested huge money in China 2 years, 3 years back. They invested only in China. They redeemed from India. And after that, China went down 40%. So I think opportunities are across. It's all up to you, your competence. If you have competence to identify companies, why China? Even Europe, Germany, Brazil, Russia, South Africa, Japan, and the world is you. Commodities, currencies. But you must have competency to do that. Ability to monitor business cycle is critical to do that. And it is ultimately your hard-earned money. And if you think you are confident enough to generate alpha, nothing wrong about it. But at the same time, there is a myth, the common myth, that India is expensive. And I have seen slides that look at company A trading at 60 times. Look at company B trading at 9 times. But please also put the growth. If it is a Japanese company with a 0% economic growth, why it should trade at 9 times? It should trade at 5 times. Why 5, 4 times? I don't know. What is PEG? Anything multiplied by 0 is 0, am I right? So it is a yield story. It is no more a PE story. Correct? So comparison must be right. Don't get carried away, correct, by what someone says. Do a little bit work. What is the growth of that company? I was just looking at, for example, Nestle Global. It's a fantastic company. I love Nestle chocolates and I eat chocolates, and I'm sure everybody in this room eats chocolate. We all love Nestle. But do you know what is last 10 years earnings growth? 0. And you want to compare price to earning multiple of Nestle Global compared to one good Indian retail company which is growing at 30%, and you say Nestle is trading at 20 times globally, and you look at the largest retail company in India trading at 82 times. Where is the comparison? I'm getting Nestle cheap. No, you are not getting it cheap, because PEG of Nestle, I don't know how many times, because we have 0 growth. Versus PEG of India's largest retail company which is growing at 25-30%, you are buying at what? 3 times PEG, which is not expensive. Nvidia is not expensive because it's a high growth. Am I right? Ultimately, you need to be conscious of the fact that what is the PEG and what is the underlying ROE. And if you think you are getting good company with a good growth at a reasonable PEG, just not price to earning, but PEG, then definitely you will make tons of money, irrespective of whichever country you want to invest. It can be across the world. Why China? Why not Germany? It's a fantastic economy. You should have competence to identify those companies which you think will deliver that growth. And if you can do that, Germany will also deliver you good returns. So, I basically believe into data. Company must be good, balance sheet must be strong, ROEs should be high, and there must be growth. Growth is critical. Growth is life. Without growth, there is no point. And that growth I should buy at a reasonable valuation. And once I buy, I must have competence to identify when to exit. And that's must, because buying what you would like to buy is only 50% of the job done. Another 50% is still left. When to exit? So you must have ability to predict the earnings growth, monitor those cycles, predict the regulations in that local market. And if you can do all of that, nothing like it, then exit and make huge wealth. Nothing wrong about it. But you must have competence to do that.
Sure, Rajesh. All these things absolutely, are quite insightful. Moving on to comparing the valuations and fundamentals of small caps with large caps, because there is this debate which continues, and obviously small caps are growing, at better pace of earnings. But this year started with this narrative that there's going to be now some kind of a pause in the rise of small caps, because small caps had done really, really well in last 4 years. But I have seen that maybe even in this year, small caps are not taking any breather. Though you're right in saying that in the broader sense, there are stocks which would have corrected by 30 to 40%. But if we see the indices, the correction has been kind of negligible, and obviously that could be because of liquidity at large. But how do you see when you construct your portfolio, and you have to kind of balance between the expectations of investors, which in the competitive I would say environment of various investment products expect you to deliver alpha, and at the same time you have to ensure that portfolio is stable in terms of liquidity, in terms of overall risks, and you have to align between large, mid, small. In the present context, are you leaning more towards large cap, or you think keeping it small, mid cap biased in the current context in your flexi cap style of investing makes more sense? Because ultimately we are here to see this growth in long term, and India as economy is growing in long term, and ultimately price is slave of earnings. And I like you gave example of Nestle being a large cap stock which has not grown, and maybe small mid cap stocks which you are picking in your portfolio are growing at a faster pace, and there are more opportunities in small caps and mid caps in terms of identifying some of those stocks which are growing at a better pace.
So first of all, there are many again myths around large cap, mid cap, small cap. But just to give one very important definition, as per regulator, top 100 in India is called large cap. The next 150 is called mid cap, and then everything else is called small cap. So what does it mean? Essentially, is in India there are 5,000 listed companies, and of that 5,000 listed companies, only 2% are called large cap. It means 98% of India is mid and small cap. It means India's third largest two-wheeler player is a mid cap. It means India's largest hotel is almost like a mid cap. I think now it has become large cap. It means India's largest luggage player is a small cap. It means India's largest mall is a mid cap. It means India's largest diagnostic chains are mid and small cap. It means India's second largest wire and cable company is a mid cap. It means India's largest plywood company is a small cap. It means India's largest capital goods HVDC company is a small cap. But these companies are not small. These companies are giants, but they do not fall into top 100 by market cap in Excel sheet, and therefore they all are called mid and small cap. In my view, if you ask me personally, what we do internally is that we put a net profit column next to market cap column, and we say, let's see how the buckets of the net profit moves. And out of 5,000 listed companies in India, there are only 800 companies in India which makes 100 crores reported net profit after tax. To me, that top 100 companies are actually large companies. Their market cap might be small. They are tagged as a small, but the companies are not small. The companies are big. So whether it is my AAA IOP, which is multi-cap, or whether it is my AAA Budding Wish, which is a mid and small cap, is probably India's only mid and small cap PMS in the country, which does not invest into any mid and small company by profit size. Company must be big. Market cap can be tagged as a small cap. And that's how one needs to differentiate the difference between the market cap. So in my view, top 1,000 companies are actually large companies, and everything after 1,000 are actually small company, mini companies, and micro companies. And if you ask my personal view, that is a space which one investor should ignore, the small, the mini, and micro. But if you look at the top 1,000 companies, that is an investable universe. And hence, when one says that, avoid small, I don't know what do you mean by that. It means avoid 96% of the market? That's my question. Or it means avoid small means from 1,000 to 5,000. There's a difference. In my view, avoid 1,000 to 5,000. Don't avoid 0 to 1,000. Because please remember, 0 to 100 is large, but where is the growth? The growth, bigger growth, better growth, more importantly, the proportion of that companies which can offer you higher growth is actually starts from 70th or 80th or 90th company, and from that 75th company to 850th company, actually you will see the bigger growth, you will see the higher growth. And that doesn't mean that they are small companies, they are big companies, but they are tagged as a mid cap and small caps. Like I told you, the largest wire cable company, the second largest cable company, third largest cable, they all are debt free. They all have 20% ROE. They all have 60% OCF to EBITDA, but they are tagged as a small cap. That doesn't make them small. India's largest plywood company is one of the best company in this country, but they are tagged as a small cap, but that doesn't make it small. So moment you differentiate between profit size and market cap and your tagging mechanism, that myth gets burst. So if somebody tells you, do not invest in mid and small, I think he's telling you, do not invest into 98% of India's universe. I don't agree. I think there are enough opportunities in the first 1,000 companies in India by market cap. And these are the companies which are making 70 crores plus reported net profit after tax. Of that, about 800 companies. There are almost 500 or 600 companies which are under leverage. Many of them are zero debt, zero borrowings. Most of these companies have a good ROE, 12, 14, 15, 18, 25, 30% kind of ROE. And then you need to check where I'm going to get growth. And that's how what we do by doing the selection, rather than get carried away by the tagging mechanism, which in my view has probably certain limitations while approaching this company. So never ask, is it a mid cap or is it a small cap? But always ask, what is the profit size of company? Is it a small company by profit size, or is it a small company by market cap? If it is a small company by profit size, avoid, irrespective what is market cap. And if it is a large company by profit size, evaluate it irrespective of its market cap. Just because company is large, it doesn't guarantee you the market cap returns and the growth. I can give you many examples. The fifth largest private sector bank, we all are aware. What happened to it? Am I right? Earlier, some other private sector bank, one of the largest, the top 10 private sector bank, we all know what happened to it. Correct? Just being large doesn't guarantee you the growth. Forget growth. Just being large doesn't guarantee you the safety. So there are many, there is a notion that today the large cap is trading cheap compared to say mid cap and small cap. I don't agree. Because again, you need to look at the growth. What is my large cap growth? If India's largest IT company trades at 21 times price to earning multiple with a 6% earnings growth, that is 3.5 PEG. Is it cheap or is it expensive? I leave it to you to judge. But if you buy a company with a 40 price to earning multiple, but with a 22% earnings growth, debt-free balance sheet and 40% ROE, 2 PEG, is it cheap or is it expensive? Again, I leave it to you to judge. But we focus on more of these businesses which have a good growth potential, reasonable valuation on PEG basis, with a strong balance sheet, super ROC and super ROE. And believe me, there are enough opportunity to invest across, be it large, mid or small. You must know the art of identifying the companies at the right evaluation of the business side.
Thank you, Rajesh. We have done enough education of our clients over last 6 years, and bang on, absolutely. And that is where our clients have made massive wealth, because it is important to come out of perceived notions. But this industry, wealth management industry, is like unfair. People keep spreading notions in line with the comforts of investors, because that is what drives sales. But we kind of have changed or tried to change this industry, from I would say relationship based selling to information based informed investing. That is a change. That is a change, that we have tried to achieve, and that was the cause which led me to start this platform BMSAI World 5 years ago. Thank you so much for your time, and thank you everyone. I kind of leave it to now 35 guests that we have. If anybody wants to ask any question, because this is first time we are doing it like this, I do not want my clients to kind of feel bad that I did not give them chance to ask any questions. If anybody wants to ask any question, you're most welcome to ask Mr. Rajesh Kothari. Perfect, Rajesh. I think you have covered it enough, and your talk was backed by data, backed by fundamentals, and backed by, I would say, a lot of realistic, practical experience. Thank you, everyone. Thank you, each and every guest, and I really again apologize for the confusion we had in the beginning. And parallelly, I have received some other options, other than Webinar Jam that we have been using, sent to me by my clients that Kamal, why don't you use those other options? But I really thank you everyone for who love us so much and then who see us in each and every step, be it I would say step upwards or the kind of uh, kind of a I would say bad thing that happened today that we were unable to do this call at Webinar Jam for some reason. But again, I thank you all who have joined us on this Zoom. Thank you, Rajesh, once again for your
Thank you, sir. Thank you, Kamal. Thank you very much for this wonderful opportunity and looking forward for more such interactions. Thank you.
my pleasure.